We're in the last video of our series on premium finance. And so if this is the first time that you're hanging out with us, I just let you know that we've done several other videos. We started with what is premium finance? Who is it a fit for? We went on to talk about premium finance for estate planning, premium finance for buy-sells, and then premium finance in combination with real estate. And we wanted to round out this discussion just talking about some of the different really poor designs that we've both seen in the premium finance space. And the reason we wanted to do that is because we mentioned in a previous video, premium finance can be a phenomenal idea for you if it's done right. And at the same time, if it's done wrong, it can be a real source of pain. And so if you're going to venture into this, number one, you need to understand the risks. And number two, you need to make sure you're working with someone that's actually looking out for your best interest. And unfortunately, both Dan and I have seen lots of premium finance vendors and designs that just don't do a good job of really putting the client first.
So Matt, let's talk a little bit about vendor.
Okay.
Or intermediary, because that's what we are, right? I mean, so what does that mean? That means that we went to insurance companies and other people and explained to them how we structure the designs of these plans, and how we do the renewals, because this, again, is a long-term transaction that we're dealing with a bank, and the bank needs to get paid back. And with that being said, is that when we're chosen to be a vendor and intermediary, what that means is that in order for someone to do this type of transaction, they need an intermediary or a vendor to be a part of the transaction. That's usually in the form of an application split that we have access to information that we can help with the transaction. So
vendors have been vetted. Is kind of the key there.
Yeah, and I think so. And the hard part about it is that this is a business that there's a lot of money involved in it. There's a lot of premium dollars that are bigger. With that being said, is that not all vendors are created equal, right? And I'm not saying I'm the greatest, but what I am saying is that when I sign up for this transaction, is that I go into it saying that it's my responsibility to make sure that the lender gets paid back and the client has the benefits that we're promising, and I'd rather be more conservative than to be more aggressive. So why don't we talk about like some of the aggressive things that we've seen, because I mean, they can be really, really crazy.
Yeah. So I'll start with how I like to do things and just juxtapose that with how I've seen some more aggressive things. So, when we're running premium finance designs, what we will normally do, and this because I ask every time we do it, is I'll say, show me the first several years of the policy performance having no performance.
Right. Well, let's clarify, Matt, then with performance of the policy, because there's different types of policies. So talk about when you're talking about an index universal life. But a lot of people will finance a whole life policy, which is a little bit different. So explain that before we go into that.
So when I'm talking about we'll show a couple years worth of no performance, I'm talking about an index universal life insurance policy where you're going to essentially participate in whatever index you've chosen. If we make it easy, we'll just say it's the S&P index without dividends.
Right.
So you're participating in the price action of the S&P.
Right.
And the most that you can gain on any given year is going to be called the cap. And caps are anywhere from, let's just say 9 to 12%, maybe right now on the S&P.
Right.
But on the flip side, if the S&P is negative, you don't participate in the downside.
Right.
Now, you still have fees, but from a price action, you don't have negative performance from the S&P negatively performing.
So that's important from a lender standpoint. When we're going to these lenders who are giving us the money to buy the premium, no lender is going to give us money that can be reduced, their premium dollars be reduced by market volatility.
Yes. No lender is going to lend us money and base our collateral on us telling them we're going to get a 7% this year.
Right.
That's not good enough for them.
Right.
Yeah.
Right.
So we will show a 0% return.
Right.
I like to show a 0% return for 2 years because the client is now seeing what is going to be required of them if the policy does not perform.
Right.
And if it does perform, It gets easier.
Right. And the requirement is that the difference of the cash value in the policy because of earlier surrender charges, it's not all the money that goes in is not available.
That's
now,
right.
There's more money in the account, but it's not all available to them. So what a bank will do is say, hey, if I gave you $1 million and if I cash out your policy, Matt, it's only worth $700,000. What happens?
Well, it's only worth $700,000.
Right. So what's the bank going to say to you?
I'm going to have to post the difference between the total value of the loan and the $700,000 that the policy is worth.
So we have to come out of pocket with $300,000. So you're saying that when you do this, you want to make sure, hey, I know that if the policy doesn't perform, this is what the value is going to be. And preparing your client to say, you may have to post this in collateral. We don't want you to, but this is going to be a requirement.
It's a possibility.
Right. So that's really smart.
So let's juxtapose that to some of the aggressive designs that I've seen. I've seen policies where the vendor, or maybe they're not a vendor, it's just someone who has a spreadsheet. They will show that the bank is giving 100% of the collateral value on the policy, and they will show a perpetual 7% rate of return forever. And when I see a design like that, I know that, man, they are being overpromised. The client is being overpromised on how that transaction is actually going to play out once renewals come, and once maybe they don't get a 7% return or an 8% or whatever's on the spreadsheet. You know, what if they get a 3% rate of return, and what if the bank only gives them 95% of the value of the policy, not 100%? All of a sudden, the collateral picture changes drastically.
Right, and that is, I mean, that is one of the things that, you know, when you are working with a client, you know, just because they have the net worth doesn't necessarily mean they're the best candidate, right? Because they may not have cash flow. They may not have, if all their money's tied in, like we talked about earlier, in their business, they might not have access to a lot of cash flow. And if anything doesn't work out perfectly, we got a lot of problems.
Talking about working out perfectly, I've seen many policies where things do have to work out perfectly in order for the bank to ever get paid back. And that's not the kind of policy that you want, where everything has to go exactly perfect in order for you to get out of the bank's loan and basically exit the transaction. There's no safety margin built in. I've seen many, many designs with absolutely no safety margin built in.
So safety margin wise, I mean, I think it's important to understand like the components that make it more risky than it needs to be, right? I mean, so one we talked about is you know, showing interest rates on the assumption of the insurance policy doing better than it could. And what about from a lender standpoint? I mean, I'm seeing, you know, what about like designs like I've seen where, you know, the rate is 3%.
Forever?
Yeah.
I've seen a lot of those.
I've
seen 3% forever rates, which obviously, you know, unless you purchase a fixed rate, which that's not what we're talking about. We're not talking about
But I know
a
we've
client.
done that for a few of your clients. You know, that was the right timing. So in your mind, you feel like you're overpaying for the rate because it's lower, but being fixed, right? But that was a smart play.
That was a smart play. But what you're talking about is people, they're not actually getting a fixed rate. They're in a variable rate, but the projection will show a fixed rate forever. Oh man, that's about as aggressive as it can get in my mind. Have you seen the policies where the loan is floated forever? To me, that's another one. Where for you at home, maybe you don't understand what we're talking about. Dan and I will always have an exit strategy for the loan. If you can't pay the loan back, then in our minds, this transaction isn't working.
And so I mean, the floating rate loan, I mean, in my mind, you know, in yours too, Matt, is that, you know, my goal is that the client pays as little as possible, but they still have to pay whatever is, you know, the market rate, right? I mean, but, you know, trying to get the lender out of the picture quick as possible.
That's the name of the game.
And so Matt, how about, I mean, I've seen people like you and I, vendors, that get paid by the bank.
Yep.
Okay, that's not too much of a conflict of interest. I mean, I mean, when would I pay the bank? I don't know, but the point is that we need to get the bank out of the picture. And I think you minimize the risk dramatically by getting them out as quick as you possibly can, because the longer you float, and so we've seen what happened in 1 year, this year.
So I've seen policies where the idea is to never get the bank out of the picture.
Right.
Why get the bank out of the picture? Because they're projecting a 3% cost of borrowing for the next 60 years, and they're showing a 7% rate of return on your IUL policy. And surprise, surprise, 7 over 3, there's no risk, and you end up a multi-billionaire.
Right.
Because that's how math works.
Right.
But that's not realistic.
Right. But the point is that if you're having conversations with the client, right, and say, and then every year we look at that and say, hey, we have enough to pay the bank off, but we're getting money at 3%.
Sure.
What do you want to do? And most clients by that point in time understand the strategy enough to say, let's just let it roll again. I want to let the money grow.
If you are going to get a 7 over a 3, if
you're
going to get a 7% return over a 3% cost of borrowing, then of course you float the loan.
Yeah.
I've seen policies where they project that 7% return over a 3% cost, and then they use that spread to generate tax-free income out of the bank. They borrow more from the bank.
From a different bank or something. Yeah. I've seen that too. And man, I mean, like,
that terrifies me.
Yeah, but you remember how we talked about in our other videos about real estate guys that, sell a property, pay the bank back. So less money's coming out of the policy. So there's more growth. And I mean, that in and of itself, just simple math, that's going to provide more value.
Yep.
But if I'm never taking money out of the policy, never paying a bank back, okay, that's going to be a dangerous situation that, is because
you get 2 or 3 zeros in a row,
yeah,
and you might have a policy that actually has no value at all at that point, because the loan just continues to float.
Yeah. And I've had clients that I've paid the bank off probably sooner than I should have, but with letting the client understand that they're going to have to put more money into the policy, because some of the loans that I can get internally from a policy might be guaranteed, for the life of the policy at a lower rate than the current lending rates, So, but you have to have conversations, and this is not a strategy that is going to be, something long term. You want to, but clients need to understand that what's happening, rather than being surprised.
So we've talked about the importance of stress testing the return and not just showing some pie in the sky number forever. We talked about the importance of stress testing the loan rate on the loan side and not just showing some fixed cost forever for the next 30 years. We talked about the importance of getting the bank out of the picture really as soon as you possibly can and taking that risk off the table. We talked about working with vendors who aren't actually vendors and how that can be a risky business. We talked about working with a bank where the bank is actually paying or involved in the transaction from a financial standpoint. The bank is maybe paying to have that business on the books. That's not a situation you want.
And sometimes, Matt, have you ever seen the strategies where when you pay the bank back and you are designing this for tax-free distributions in the future, right? I mean, the illustration will give us a number that, is sustainable, right? And I think that a lot of our designs are really, taking the illustrated numbers inside the illustration that a client signs and putting it in our model, right? But I've seen stuff like I couldn't figure out the numbers, and I'm thinking like, how does this work, right? And then what you find out is there's a separate spreadsheet that has market. Well, this is what actually happened in the market. So instead of getting the illustrated rate of 6 or 7, they're showing 12 and all these other things. And I've had clients that have come to me with these and saying, Dan, the collateral doesn't make sense because I thought my cash value in the policy was going to be so much bigger, but they were looking at stuff. And what's interesting is that the vendor that was doing this was saying that if you don't have a vendor that does these stress test models, then he does not know what he's doing. And I'm going like, why would I do that?
In the meantime, they're showing the best stretch of 40 years in market performance.
And even the worst 40 years is usually better than the conservative illustrated rates of policies.
That's right. So yes, I've seen using market performance instead of the actual numbers from the illustration to generate the sales material, which is a huge no-no, and definitely set up to overpromise and underdeliver.
But it is important to note that, like, the policies can perform better than illustrated,
Totally.
right? I mean, that, and like, so, there may be one policy that I can only illustrate 6%,
Yep.
right? But I can get a 10, I can
Sure.
get a 12. I just can't show you that.
Sure.
I want to do that, right? But I can't show it. So, like, you'll get some clients that say, Dan, show me what it looks like at 4%. I said, I don't need to show you. It's going to look terrible, right?
Yeah,
I mean,
right.
so, but it's the same thing as if I took an investment in the S&P, and then do I go to my guy with the S&P and say, show me the S&P at 4%?
No.
It's going to look bad, right?
Yeah.
I mean, so it's all relative.
Yep.
But the point is that there is some really crazy stuff that people, I think, unfortunately, don't really understand how the policies work. And they need to understand, and that may take a little bit of time, but they need to know these risks and the things that happen, because, a lot of these strategies that I look at is just saying, like, wow, this is like not going to work.
Which obviously is the worst case scenario,
Right.
because now you're leveraging money into an asset that if you or I saw it, we would say, this isn't going to work. And if you're borrowing money to put into a transaction that's not going to work, you're just creating a problem for yourself.
Right.
In a leveraged fashion.
In a leveraged fashion, but then you get the clients that'll say, well, I like what you guys are talking about. So can you take this over for me?
Well, that's difficult to do.
It is because, Matt, then, if it's not properly structured yet, do you want to help the people? Absolutely. But the fact is that,
There's still an outstanding loan, and there's a cash value.
Yeah, and there's risk involved for, just because we take it over doesn't mean it's going to be perfect.
No.
So you just have to be careful with this, and hopefully, on the front end, you're able to get a second opinion of something that we look at, because, we're talking about bad designs.
Yep.
There's a lot of good designs too,
There's tons of
Matt.
good ones.
But the point is that, you got to make sure that you have people that are a team. Like, the interesting part for me was when I did this with the insurance carriers, got approved and everything like that. One of the questions they asked me was, if something happened to you, Dan, what are you going to do?
Yeah.
And that's where you get, a guy like Matt or that we can work with each other. So we got to make sure the transaction gets taken care of for the client. And so they want you to have a team that knows what they're doing to do this, because, like we said, this is not a one-year transaction, right? I mean, so, this has been fun, but I mean, there's a lot of bad stuff out there, and there's some good stuff, but, you just have to know what the risks are.
That's exactly right. If you're a client who's looking at a premium finance design and you don't know if it's good or bad, the reason we're talking about bad designs is really just to raise awareness. So reach out to us. We will review that for you for free and let you know, is this a good design? Is it a bad design? Could it be improved? And what you do with that after we talk is totally up to you. It's a no obligation, just way for us to try to help people get this right. If there's any transaction that you want to get right, it's anytime you're going to add leverage. You want to get it right. And so we want to help you do that. If you're a financial advisor or you're an agent and you're working with another vendor for premium finance policies and you suspect that maybe they're not doing things in the client's best interest, reach out to us. We'd love to help you. We'd love to help you get this right. Dan does a great job of communicating with clients and really putting their interests first and making sure that all the designs that go out are designs that can work, the lender can be paid back, the client understands the risks, and it's a win-win scenario all the way around.
So with the way these are designed, Matt, we have, third-party lender. It's in essence, it's really finding someone else to fund your policy. But I mean, it is a little bit more complicated than that, right? I mean, so the point is that we as vendors or intermediaries, we don't expect our advisors we're working with to understand all this completely, right?
Yep.
I mean, so a lot of times, we're going to be, designing something, showing the client, and the great thing about Zoom and other things is that we're able to do this all over the country for clients, explain these features and benefits to them, And if the financing strategy makes sense, they're going to work with us, and we're going to make it happen. But the point is that, you know, we're going to help our advisors that we're working with make sure that it's explained properly to the client. You know, that they understand the transaction to the best of their ability, right? But the point is that, you know, we're going to utilize this strategy because it makes a lot of sense for a lot of good planning. But the point is it's not for everybody, right?
It's not for everybody.
But the point, and we want to make sure that the advisors are working with that have success, because this is all we work on, is doing this for advisors and their clients around the country, right? I mean, so we're getting them in this process. And if it doesn't make sense for the client, then the advisors can figure out different strategies that can work for the client, right? I mean, so it's been great. And I think that, you know, make sure you understand what you're buying before you buy it.
Absolutely.
Right. So
thanks for hanging out with us in our discussions on premium finance. If you have any questions at all that have been kicked up over this series, please reach out to us. You can go to our website, leveragewm.com, contact us, or book a meeting. But again, thanks again. This is a complicated transaction. We did our best to make it simple and to kind of bring it down to earth and make it just more of a general overview. If you want a specific example just for you, you'll need to reach out to us, because these plans are not cookie cutters. But thanks again, and we'll see you soon.